Greetings, everybody. Welcome to Liberty Call. Today is Friday, February 3rd, 2023. Hope everyone is having a fantastical day. This is our weekly wrap-up of everything that occurred in the stock markets and the economy this week. Got the indexes for the week, a bunch of economic data that came out this week. Some good, some bad. And market recap. Jobs numbers look really good, which is making the market not react very well. And then a final article here. Let's see what it has to do with as far as what the Fed's going to do as far as raising rates. So if it's your first time watching, please give me some thumbs up, likes, shares, subscribes, follows, all that good crap. I greatly appreciate it. And let's go ahead and jump into the numbers and see how they turned out for today. Lots of red here domestically. The Dow Jones was down 0.38%, closed at 33,926. S&P 500 down 1.05%, closed at 4136. NASDAQ down 1.59, closed at 12,006. Small caps are down 0.54. The VIX fell today, which again is odd because the S&P 500. We talked about this yesterday, how they were disjointed and not moving in tandem. But the VIX was down 1.76%. It's currently holding at 1840. Canada was up 0.09, Brazil down 1.32, Mexico up 0.28. Across the Atlantic, Germany down 0.21, UK up 1.04%, France up 0.94, Euro stocks up 0.4, Netherlands is up 0.69, Spain down 0.04, Italy down 0.55, Switzerland up 1.44, and Portugal down 0.55%. Russian exchanges were split today. MOEX was up 0.21, RTSI down 0.16. And the overnights in Asia, again, split markets. Japan was up 0.4, Australia up 0.62, New Zealand up 0.29. The Shanghai and China down 0.68, the SE component down 0.63, China 50 down 1.3, DJ Shanghai down 0.76, Hang Seng down 1.36, and the Taiwan weighted basically flat at up 0.05%. So that's the trading day for February 3rd. And again, kind of weird. The Dow was in the green a lot of the today. And actually, let me bring up the chart. We can just look at the chart and instead of me trying to describe it. So here's the Dow chart. You can see most of the morning was in the green, but then took a solid nosedive around, what time was this? About 1 o'clock Eastern. It's about 11 o'clock my time. The Dow took a dump and went into the red. See, kind of the same chart with the S&P 500, but it never, for a couple of spots here, got above the midpoint, but most of the day was in the red. Same thing with the NASDAQ. So let's go ahead and look at the weekly chart here and start out. Let's see how the Dow Jones did for the week. Dow Jones is going to finish the week off pretty flat, down 0.02. The S&P 500 is going to finish the week off up 2.14%. NASDAQ finishes the week off up 4.43%. So NASDAQ had a pretty good week. Dow Transports up 7.44%. And the Dow Utilities is going to finish the week off down 1.5%. So that's the one. The Dow Utilities in the red. The Dow Transports was outstanding. And then the other three, like I said, the Dow was pretty much flat. And the S&P 500 and NASDAQ had positive weeks. So let's take a look at the longer term trend. This is the S&P 500 going back to the beginning of last year. If we zoom in here, we can see where we've broken this trend line for now. But, is it going to be very similar to the Dow where it broke the trend line and has been trading sideways really since December? So, with everything that's going on right now in the current economy and with inflation and what the Fed's doing, I just don't have a lot of hope for a strong rally that's going to eclipse the previous highs from the beginning of last year anytime soon. So, again, I could be off base, but unless the Fed does something really drastic, such as slashing rates and doing a lot of QE here in the very short future, like they did 3 years ago, starting in, I guess, March and April when they started talking and floating the ideas of all that stimulus. Unless they do that, I really just don't see the markets having a huge rally. You might see some sort of a short-term bear rally that I've talked about already this week, but I just don't have a lot of expectations for where things are going on the short term. So let's go ahead and look at the economic data that came out this week. Initial jobless claims came in at 183,000. The forecast was 200,000. Last week's number was 186, so right in line with those numbers. Continuing jobless claims came in at 1.655 million. Forecast was 1.66 million. So I'm sorry, 1.677 million. Last week's number was 1.666. So again, staying right in line with the numbers from the last few weeks. The JOLTs report, the Job Openings and Labor Turnover Survey, there are currently 11.012 million jobs out there. The forecast was only 10.25 million jobs. So they're off by 750,000 right there. So that's not real good. The ISM Manufacturing Purchasing Managers Index came in at a 47.4. Forecast was 48, so just a hair below the forecast. Last month's number was a 48.4. So anytime this number is below 50, that usually is a sign of contraction in that particular index. So, it is dropping from the previous month, and from looking at the trend, it's been in a steady decline going back more than a year at this point. The ADP non-farm employment change, there were 106,000 jobs added to the economy. Forecast was 178,000, so off by almost 50% there. Last month's number was 253,000. Factory orders month over month grew at 1.8%. The forecast was 2.3, so about 0.5% off there. Last month's number was a negative 1.9, so we did get back into the positive this month. We've had a couple of negative months last month, and this was September, and then just some really small months in between the two. So U.S. non-farm payrolls, let's see here, shows the number employed grew by 517,000. Forecast was 185. So again, these, between ADP and then these other payroll numbers, they're all different reporting agencies. So they are going to be a little off from agency to agency. But again, big number miss. Yes, it was above forecast, but the forecast was obscenely low. Previous number was 260,000. The unemployment rate is currently holding at 3.4%. Last month's number was 3.5. The forecast was 3.6. So again, these government prognosticators are not very accurate most of the time. And then last is the Services Purchasing Managers Index, came in at a 46.8. Forecast was 46.6. So beat the forecast. We also improved from last month's number of 44.7, but we are still below 50, which is a sign of contraction also. So again, we've been in this steady slide for quite a while. We'll have a nice jump up like we did here in October, and then it'll start sliding down again. So, all righty. Well, that's everything as far as the economic data. Let's go ahead and bring up the market recap for today. SP 500 slides as blowout jobs report, dents, Fed, pause hopes. And what they mean by that is that the hope was that the jobs numbers would start to not look as good as they have. And that would give the Fed, a green light to either pause rate hikes, or, what they would really like to see happen is have the Fed start lowering rates back down so that, their friends on Wall Street could improve their investment portfolios, because growth stocks have just have gotten clobbered over the last 12 months, or I guess 13 months at this point. And, I'm sure their friends are breathing down their necks saying, dude, what are you doing? Let's drop these rates so my investments can look better, So anyways, all right, well, let's go ahead and let me bring up my notes here. Where are we? Oh, let me see. Missing part of my notes, so let's just hang on a second. All right. All right, so let's see here. The SP 500 declined in choppy trading this last Friday due to a decline in Amazon, which weighed on consumer stocks. Just as the strong jobs report dented hopes for an earlier Federal Reserve pause on rate hikes, data showed that the U.S. economy created 517,000 jobs in January, well above the estimated 185,000, leading to a revision of calls for a Fed pause next month. Treasury yields rose as investors priced in a more hawkish Fed, with expectations for a March hike nearing fully priced in, and the May hike increasing to 57.5%, up from 30% on Wednesday. Consumer stocks led the market lower due to a 7% decline in Amazon after the company reported Q4 earnings that missed on the bottom line and soft guidance for Q1. Apple rose 3% due to positive remarks by CEO Tim Cook and growth acceleration in China after their lockdown. Alphabet fell more than 2% due to weakness in advertising and lower economic spending. Starbucks delivered results that fell short of estimates, while Ford Motor Company also missed earnings and revenue estimates due to execution issues, and that's in quotes, that impacted sales. Nordstrom surged 23% due to activist investor Ryan Cohen reportedly taking a stake in the retailer. So that's all the news it's from this current trading day. Let's follow that up with a article here. U.S. reports blowout job growth, unemployment rate lowest since 1969. Woo! That's a long time ago. That's when my parents were finishing up high school. All right, let's go ahead and let me bring up my notes. The U.S. job market U.S. job market showed robust growth in January, with non-farm payrolls rising by 570,000 and unemployment rate falling to 3.4%, a 53.5-year low. The report also showed stronger than previously estimated job growth over the past year, putting the economy far from recession. Again, I don't know why they think jobs numbers have anything to do with recession. Recession is typically judged upon GDP, and when you have two negative quarters of GDP, that is a recession, like we had the first half of last year. Whether or not the positive numbers of the second half of last year show us that we're not in a recession anymore, I don't know. That's up for debate. Job growth came from a variety of sectors, with leisure and hospitality leading the way, adding 128,000 jobs. Despite layoffs in the technology sector, the tight labor market could lead to inflation and a potential headache for the Federal Reserve. This, combined with data showing a sharp rebound in the services industry, suggests the Fed could lift its target interest rate above its recent projection of 5.1% and keep it there for some time. If you've been listening to me on a regular basis, I think they're probably going to have to go above 6. That's just my personal gut feeling based upon a bunch of smart people that I read and their opinions on the situation. The report also showed a slowdown in wage inflation, with the average hourly earnings increasing by 0.3% in January and the year-on-year increase in wages falling to 4.4%. So, all right, so that's everything in that article that I wanted to cover. And last up comes from our friends at Mises.org, the Mises Wire. This article is titled, "The Fed is already flashing signs it's done raising rates." And again, this is a very bad sign if the Fed, like I said earlier, if they change their tune and reverse course, throw the ship into reverse and try to avoid the iceberg, odds are they're probably still going to bump into it like the Titanic did when they turned the wrong way. But let's go ahead and this comes from Ryan McMacken, and he's a real smart guy too. So let me bring up my notes. The Federal Reserve's Federal Open Market Committee increased the target policy interest rate, also known as the federal funds rate, to 4.75%. This marks This marks a 4.5% increase in the target rate since February of 22, so basically a year. But the latest increase of 25 basis points is the smallest in the past year. The FOMC has been slowing down its monetary tightening, but denied plans of ending or reversing rate increases. Again, if they get enough heat from the powers that be around them, they will turn tail and go the other way. Let's see here. The FOMC has been slowing down its monetary tightening, but denied. Oh yeah, we read that. The FOMC stated that it intends to continue raising rates in order to bring inflation to the 2% target over time. However, these predictions of future behavior are unreliable, as they've been proven wrong in the past. Again, we can look back to 2019 when the Fed was raising interest rates. And actually, we can look at this chart right here. So We can see here back in 2019, rates went from, 0.25%, 0.5%, wherever it was down here, from 2009 through just before the election in 2016. And during the Trump administration, it was going up and up and up, got up to about 2.5%. And if you recall, I know I've talked about this a lot. You had a lot of problems in the repo markets, not repossession of cars, but the repo markets are the how money is swapped between banks so that their books look good on their overnights. And those rates were getting out of control. And, at the time I was like, this is not a good situation. A lot of the people that I read were like freaking out. And, shortly before the whole COVID thing happened, they started lowering rates at the end of end of 2019, and then back down to zero due to COVID. So we can see we are back above, we're almost to where we were prior to the market meltdown in 2008 and 9. But anyway, so like I said, the point is that these are not reliable people. They will turn the other way at a moment's notice if they think they're going to save the economy from a certain disaster, which, in the end, they usually wind up doing more damage, in the future. So the FOMC also has plans to continue reducing its holdings of Treasury securities and agency debt, as well as mortgage-backed securities. Despite FOMC Chairman Jerome Powell's reassurances, the market expects the Fed to stop raising rates and eventually bring rates down. And I know I pointed this out quite a bit over the last year, where these financial journalists have been cheering on lowering rates before we've even made a dent in the inflation that we've been experiencing. The FOMC predictions and monetary policy are considered to be unreliable, and so is their goal to create a soft landing. So, all right, that was everything that I wanted to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical weekend out there in the interwebs, and I will talk to you guys next time. Adios.